Volatility and risk are two of the most misunderstood concepts when it comes to investing. Bitcoin is a great example here. Many people on the sidelines still view Bitcoin as extremely risky because of the fluctuating price. In this video, we cover why you shouldn't be afraid of price swings, how Bitcoin compares to gold and fiat currencies, the misunderstood relation between volatility and risk, as well as Bitcoin as the actually most stable thing in the world. And with that, I welcome you back to another video here on the channel. I've talked about volatility before, but as I learned more, I can now share more. I also found a few interesting graphs and comparisons that I want to show you. And that's exactly what we will start with. This graph shows you Bitcoin's price and the 60-day volatility index of the BTC-USD trading pair. As you notice, the green log chart of Bitcoin's price goes up and to the right, as it should. The black volatility graph looks like the term suggests, volatile. It shoots up and down a lot with the highest peaks in the early days of Bitcoin. Since then, it sits somewhere between 4 to 5% on the yearly, with 2016 as an exception. The usual argument you hear is that this price instability is a result of Bitcoin's low market cap. Gold, for example, is less volatile because it is 10 times bigger. But this is not the complete truth. At the very least, it's an incomplete argument for which you can easily find counterexamples. Take a few fiat currencies with a lower market cap. The Thai baht has a lower market cap than Bitcoin, but the baht-USD pair is much more stable than the BTC-USD pair. Maybe it's less about the market cap and more about how long something is around, so that the market is able to price it more accurately and therefore more stable. Right now, Bitcoin is still in an exponential monetization process, which we call price discovery. Volatility is variation, and variation is information. I would say that volatility will somewhat reduce if Bitcoin continues to grow dramatically as it becomes harder to move the market, but it might never be as stable as people say it will. Stability only arises when Bitcoin becomes the unit of account. So if not for the market cap, what is the major reason for the price swings? Speculation and especially leverage trading. Bitcoin as a system is in fact very stable. The monetary policy, 10-minute blocks, non-existent terminal inflation rate, etc. But that doesn't necessarily mean that people look at Bitcoin every second and see it with the exact same value. And if people's subjective value of it changes, so does the attached price they are willing to buy or sell it for. A market consists of many individuals making individual choices. News, narratives, and momentum have a huge impact on Bitcoin's price. Listen to Alex Svetsky emphasizing this point.
And the thing is, we just need to be careful about how we define volatility, right? Volatility in relationship to what? Because Bitcoin in its own sphere is actually not volatile. Bitcoin's the most unvolatile thing that exists today. No one changes the code base. Like, it takes 4 years to roll out Taproot. Like, Bitcoin is the definition of anti-volatile. But in I guess the madness of the crowds, which is people discovering how to value this thing called Bitcoin, there is volatility in perception. There is volatility in subjective valuation. There is volatility in how people understand, appreciate, and form an opinion with respect to what Bitcoin is valued for themselves. So that's volatile. But Bitcoin itself, it's not volatile. Volatility is inherent to things like central banks, because What do? They change their mind every day or every week. First inflation's transient, now it's not. Now it's because of people didn't get vaccinated, or then tomorrow it's because of global climate change. Tomorrow it's because, toxic masculinity. That's volatility. Volatility in opinion, volatility in policy, volatility in everything. Whereas Bitcoin is it's fundamentally not volatile. Bitcoin's the only heartbeat that exists in the world today that we can point to and know that it's there, hasn't changed, it's still what it is, it's backwards compatible for 13 years. That's perfection. And it's the relationship between a volatile world and a perfectly pristine manifestation of a heartbeat. That connection is volatile.
In a recent article, crypto trader Cred explained the concept of capitulation. In my eyes, this also gives you a glimpse into volatility as a whole. The basic premise is essentially everyone who wanted to sell and a ton of people who didn't want to sell but were forced to sell, sold. This is what happens when liquidations of leverage positions occur. Now let's talk about this major misunderstanding that I mentioned in the beginning, the connection between volatility and risk. The following quote is placed on the site that published the Bitcoin price and volatility chart. I was quite surprised by it. Volatility means that an asset is risky to hold. On any given day, its value may go up or down substantially. The more volatile an asset, the more people will want to limit their exposure to it, either by simply not holding it or by hedging. This is not true. I wouldn't even say it's a simplification, it's rather a misunderstanding. Volatile things are not necessarily risky, and the reverse is also true. Famous macro analyst Lynn Alden opens her brilliant article Risk versus Volatility: How to Profit from the Difference as follows. One of the most commonly mixed up concepts in investing is the difference between market volatility and market risk. Many people treat them identically, which is a mistake. If the two were to be so closely related, there wouldn't be any high volatility, low risk examples, or low volatility, high risk examples. Time span matters a lot here. Lynn Alden makes an example about two companies in a business cycle. I'll give you another one which is abstracted from Nassim Taleb, who wrote his masterpieces about volatility, risk, and uncertainty. A taxi driver has an unstable and therefore volatile income. An employed banker doesn't. But can you really say that the taxi driver has a more risky occupation? The banker is more prone to getting fired, changing his regular income to no income, while the taxi driver continues to have a somewhat stable income if you look at a longer time horizon. And this longer time horizon really is the key to understand Bitcoin's relation to volatility and risk. Taleb's book Anti-Fragile can be summarized into the following. There is no long-term stability without short-term volatility. In The Black Swan, he hammers it home as well. This is one of life's packages. There is no freedom without noise, and no stability without volatility. Complex systems that have artificially suppressed volatility tend to become extremely fragile, while at the same time exhibiting no visible risks. We see this with fiat currencies and bureaucracies around the world. Michael Saylor famously pointed out that it's your choice. Would you rather have a stable depreciation, US dollar, or volatile appreciation, Bitcoin? Because that is what it boils down to. Bitcoin is volatile, but historically its volatility leads mostly upwards. Its value is appreciating by an average of 200% per year since inception. Everyone whose time horizon is a few years rather than a few weeks saw their purchasing power increase when holding BTC. So don't be afraid of volatility, it's a completely natural part of the process. What happens between adoption waves is the natural function of price discovery as the market converges on a new equilibrium, which is never static. In Bitcoin hype cycles, the rise, fall, stabilization, and rise again is almost rhythmic. It is also naturally explained by speculative fear, followed by accumulation of fundamental knowledge and the addition of incremental infrastructure. Rome wasn't built in a day. In Bitcoin, volatility and price discovery are core to the process. Parker Lewis explains this process really well and makes us understand why it happens in the first place. As a massive adoption wave occurred, it was met by Bitcoin's fixed supply schedule. What would one expect to happen when demand increases by an order of magnitude but supply only increases by 10%? And what would happen if the knowledge and capital of the new entrants naturally varies greatly? The very logical end result is higher volatility and a higher terminal value, if even a small percentage of new entrants convert to long-term holders, which is exactly what happened. New adopters who initially purchased Bitcoin in its astronomical rise slowly accumulate knowledge and convert to long-term holders, stabilizing base demand at a far higher terminal value compared to the prior adoption cycle. And that's it for this video. I hope you enjoyed it and took something out of it. If you did, I would appreciate it if you leave a like and subscribe to the channel for further content, and then I see you next time.